Hi, I am Dr. K. Malavi, Assistant Professor, Department of Commerce with CE, PPG College of Arts and Science in Coimbatore. Today, we discuss about the subject of corporate accounting and the specific topic of issue of shares. Let me move on the next slide of introduction of shares. Introduction of shares. The share capital is the main source of money for a company. It helps the company start and grow its business. The people who buy shares is called shareholders. They are or the owner of the company. The more shares they buy, the greater of the ownership. The share is the equal part of the company's is called capital. If the company earns a profit, the shareholders has the right to receive the share of that profit is called dividend. It is one of the simple example of shares. A company is divided into 100 equal parts. Each part is called a share. If you buy 10 shares, you own 10% of the company and can receive 10% of the profit. This is an example of shares. Let me move on the next slide of kinds of shares. In this slide, explain the kinds of shares. Under the Companies Act, a company can issue two main types of shares. The first one is a preference share, the second one is a equity shares. In the preference shares, the shareholders get preference in receiving dividend. They also get their money back before equity shareholders if the company is closed. The second one is the equity shares. In that equity shares or ordinary share, equity shareholders are the real owner of the company. They have voting rights, but the dividend is not fixed. It depends on the company's profit. In this slide, explain the different ways company can issue shares. The first one is issue of shares for immediate full consideration. Under this heading, the investor pay the full amount at one time. The company receive all the money immediately. The second one is issue of shares in installment. Under this heading, the investor do not pay the full amount at once. They pay in parts such as application, allotment, and call money. The third one is issue of bonus shares. Under this heading, the company give free shares to existing shareholders. The shareholders do not pay any money for the shares. The fourth one is issue of shares through other method. In this heading, in this right issue, there are three types out there. The first one is a employee stock option scheme. In this heading, employee are allowed to buy company shares usually at a special price. The second one is sweet equity. Shares are given to this employee or director for the skills, knowledge or hard work. And then third one is a private placement. Shares are sold directly to a small group or selected investor or instance of the public. In this method, the company receives the full amount of shares at a one time. This consideration received by the company can be of two types. The first one is a cash consideration. In this cash consideration, the company receive money. In the second one is a non-cash consideration. In this method, the company receive asset, land, machinery or other properties. When a company buy an asset by giving shares insurance for cash, it is called the issue of shares for non-cash consideration. And this journal entry is asset account data to share capital account. When a company buy another business, the instance of paying cash, the company can give own shares to the sellers. That the first journal entry is the asset account data, goodwill account data, to liabilities account, to vendors account, to capital reserve account. The second journal entry we make it for issue of shares to the vendor. Vendor account data to share capital account. The two both entries are we make it for the one company by another company business. The issue of shares to promoters for service rendered. The first one is a promoter is a person who starts a company and helps to form it. Promoters spend the time, effort, and money to start the company. They may also help in merger or reconstruction of the company. Instead of paying them in cash, the company may give them shares as a reward for the services. On a simple story, the Gautam starts a new company. He works hard, completes all legal work, and spends his own money. The instance of giving Ravi cash, the company gives him thousands as. They make the journal entry of goodwill account data to share capital account. When a company issues shares and receives cash from investor, it is called cash consideration. There are three situations. One is a par, second one is a premium, the third one is a discount. And that par is issued the face value and the journal entry is bank account data to share capital account. For example, face value is 10, the issue price is also 10. There is a no difference. So this is a par. In the premium means shares are issued above the face value. The journal entry is bank account data to share capital account to securities premium account. For example, face value is 10, the issue price is 12. So the different 2 rupee name is a premium. Issue of shares at discount. At a discount means the shares are issued below the face value. For example, face value is 10, the issue price is 8. The rupees 2 difference is called discount on issue of shares. And this journal entry is bank account data, discount on issue of shares account data to share capital account. I hope you clearly understood for this topic. Thank you for watching this video. Thank you.